Hey, welcome to our first lecture in this course. Before we really dive into all of the functionality and techniques in Excel that you should know to become an analyst, whether you're doing analysis for financial purposes, marketing purposes, or working with data, we're going to show you a lot of very useful techniques. But before we dive in, it might be useful for you to understand the user interface in Excel. Now, depending on the version that you have, this is the latest version of Excel that we're looking at as of 2017. And some of the older versions, it may look a little bit different from this, or if you've changed some of the default settings, it will look a bit different. But regardless of the version, all of them will have a ribbon here up top that will have multiple tabs. And what the ribbon contains are some of the most frequently used features and functionality in Excel, from formatting to inserting objects and charts to using built-in formulas that can help you solve specific types of problems, to doing special things with data that will help you save a lot of time when you're working with data sets. All of these tabs are available for you when you click on any of the tab headers, and the ribbon will show. To hide the ribbon, simply just click on the ribbon that's currently shown. If you click that, it will hide it, and if you click on any other header for the ribbon, it will show that particular ribbon. Now, underneath the ribbon is this formula bar here. And this formula bar will show any formula that is in the selected cell. So for example, if I put a formula for 5 times 6 and hit enter, notice that the cell holds the value of 30, which is the answer to 5 times 6. If I select the cell and we go to the formula bar, we still see the formula that was entered previously. So when you open a new Excel file, I'm going to hide the ribbon now, it will create a new workbook for you that will contain a blank spreadsheet with these empty cells that will look something like this. Now, every spreadsheet, which is called a worksheet in Excel, will have over 16,000 columns. And these go from A to Z to AA to ZZ, and it keeps on going until the very end to XFD. Those are the labels for the columns there. Now, in terms of the number of rows, there are over 1 million rows in Excel for every spreadsheet. So if I go all the way to the bottom using Control arrow or Command arrow, if you're on a Mac, I'm able to navigate between these cells in the spreadsheet much more quickly to go from one end of the spreadsheet to another. Now, between the 16,000 columns and the over 1 million rows, we're looking at over 17 billion with a B cells in every single spreadsheet here. So that's plenty for you to work with, and we're gonna put some of those cells to work in some of our examples later. Now, below the worksheet, your work area, and on the edges, you're gonna, when you start moving using the scroll, you are able to select the scroll bars to move quicker across your spreadsheet. And below that, we have a view bar or zoom level at the bottom right that allows you to change the zoom or viewing size of the spreadsheet. So if you have more things there, if you have charts and data and you need to take a step back to look at this spreadsheet, you can do that. You can zoom out, or you can zoom all the way in to just the cells that you're working with, so that that is the most visible thing. Now, notice that in this lecture, I am using the mouse to select the cells to go from one place to the next, but as you take the course and take more of the lectures, you're going to learn some of the keyboard shortcuts using your keyboard. All right, welcome back. Now, we're looking at the same data set here. It added this table here that we're going to solve. We're going to add data here. Okay, I've scrunched up these columns here so we can see the rest of this. Now, you can select the columns that you want to adjust, and if I just move them around, it adjusts the width of all of them. Okay, if I double click on any one, it will set the right or auto fit the column to the correct size and change it. But there's a long game title somewhere down here, so it's making this really big. So what I'm going to do, since we don't need it for this exercise, I'm just going to drag them all to be something tiny. So we're kind of hiding it, and all we're looking at is the sales data here. Okay, so in this lecture, we're just going to do some simple calculations that you can do with data that's numbers. So something that's very common when you have numbers is we want to look at a total, right? We want all of this. Now, we could do something where we add them one at a time. We just add 1 plus this one and plus this one. Well, guess how long that's going to take? It's going to take quite a bit, right? We got over 16,000 data points here. So that's not going to work. What we do is we got to use the built-in functions in Excel. And we're going to go through some of these in more detail, but the one we're going to use here is sum. We're going to take a sum of that, and I'm using a shortcut, a keyboard shortcut, Control Shift down, or if you're on a Mac, Command Shift down, allows me to select all of those keys. And if I close the bracket and then enter, now I have the total. That many millions sold. Now I could do the same for these calculations here and get the other ones, do the sum and then do the sum, or I can simply copy it over. I can select the formula that I've already done, highlight the lower right hand corner, and copy it, drag it across, and notice that there are calculations for the other ones now. So the way Excel works is it allows you to build formulas to do calculations. And if you do them correctly, it can really speed up the kind of analysis that you can do on your data. So now here, I already have the total copies by region and also for the global for all 16,000 plus games in this data set. All right, now these numbers are all in millions. So obviously they sold more than 82 copies or 40 copies. So these are all in millions, all right? So what's 8,000 million? That's 8 billion here, okay? So that's a lot of copies here. All right. Now some other useful things that you can do when you have numbers that are data is you can run statistics on them. And you can find out kind of the max or the minimum of things. Now, these are sorted already, at least in terms of global sales. We know the min and the max, right? The maximum is at the top. So this here for most copies sold should equal to that. But for the other ones, it may not be sorted, right? The right way. So this one looks like it's probably there, but for Japan sales, it's not the number one game here. Something else has more sales. This one right here, right? So we need a way to effectively find the most sold the right way. And one function in Excel that allows you to do that is called max. You see, a lot of the useful functions in Excel are named in a very self-explanatory way. So we can create the function, and then we use the Control Shift arrow down, and then we end up selecting everything, the entire column. And what it does is we are saying to Excel, hey, take all of these data points and find me the maximum. That's what that function does. So that finds the maximum here, and we see that this looks like it's right. So if we copy across using the drag method, we see that the global sales does match the number here, so this is correct, and it calculated for the other ones. So we see that the top other sales category was not 8.4, but it was 10.57 here. The other max for Japan sales was this game, and then European sales was still that. Okay. Now let's look at just a couple more statistics that we can do. Something that's very helpful is, well, what if we want to know the average for each of these sets of sales? Well, we can go equal to average. Now all formulas are going to involve a parentheses that takes in some parameters, right? Because you're basically saying, I want you to take this and do something with it. So what are we going to do with the average? Well, we want to give it numbers for it to calculate the average. So again, we're going to select the cell right there that's corresponding to the North American sales, and then we're going to go Control Shift arrow down to select the rest of that column, all the data, close parentheses, hit enter, and we see that that's the average sales. And now sometimes you have a number like this where it's really long. We don't really need that many decimal places. Well, Excel has built-in functionality that allows you to quickly, with just a couple mouse clicks, to shorten or change the decimal places for your numbers pretty easily. Now, don't worry right now, we're going to go over all of this in more detail, okay? So again, now we can cut this across and we can see what the average copies sold are. So of all the games here, the average global sales was just over 500,000 copies. All right, if you know a little bit about statistics, your average doesn't equal to the median. The average is actually the mean. So a median is, well, out of all of the data here, data point is right in the middle. What would that be? What would that value be that's right in the middle, where half of the results are higher and half of the results are lower? What do you expect the median values to be? Right? If we think about it, there are some really high numbers here, and there are many more that have very low numbers, but these high sales numbers probably drag the mean or the average higher than the middle value, right? So we would probably expect the median to be lower than the averages. So how do we calculate the median? Well, there's a median function in Excel, and we give it the data points, Control Shift arrow down, close parentheses. We calculate that, and we see that it is much lower. And if we copy that across by dragging the bottom right corner of the cell across, we can see the calculations for all of these. So here tells us the median value is 0 for Japan sales. That means at least half of the games don't make any sales in Japan at all. So you can see when you have numerical data, in which case a lot of you are going to be dealing with numerical data, there are things built into Excel that allows you to quickly assess or run some statistics on your data that will give you an... Hey, welcome back. Now, we may have introduced the idea of anchoring cells or cell references earlier, but we didn't really dive into them. And you, intuitively, based on the examples, you might have understood some of that, but we wanted to go a little bit deeper here so you can fully understand cell referencing in formulas, because that's very important when you run your analysis, especially if you'll be constructing any kind of formulas that refer to different sets of data or tables. And if you make an error, you can have very, very different kind of results. Okay, so let's look at this table here. And what we're going to do is we're going to look at the reference. We're going to reference this cell here in gray at each of the corners here of these 4 boxes. Then we're going to copy that formula across the entire box and see what happens. Okay, so let's start with no anchoring. So we're just going to have this equal to that value. And we have it equal there. The value is the same. So now if we just copy and we paste, the values, because there's no anchoring, will equal to each of the corresponding cells. So because there's no anchoring, this formula is going to refer to that one. This cell is going to refer to the bottom one. And essentially, when there's no anchoring, the cell references column and row reference will both move as we move cells when we paste it. So we started here, it referenced B1, but as we got to there, it referenced E4. So however many cells we move down and copy paste here, that's how the references have changed. Okay, so now let's do it a little bit differently. This time, we're going to make it equal to this, but we're going to anchor the column reference. So we're going to put a little $ in front of the letter, but not the number, okay? So this is anchoring. So now when we copy and paste the values across in this box, now see what changes. Notice that as we go across the columns, the reference is still to column B. That's because we put $ there, we anchored it to column B. But as we go down in rows, we also move down in rows. The numbers change, but the columns do not. All of these refer to column B. So this now, all of it is equal to this column. All right, now let's look at the opposite of that, where we anchor the row instead. So we're going to go B, $ anchor the row. So again, we're still referencing the same cell here, but this time we're going to anchor the number instead of the column. So now we copy, we select the rest of this and paste. Now what do you see? We see that we're basically referencing this top row now, right? Again, we're anchoring to row number 1. But you see, as we move across the columns, the reference to the columns is moving, so the letters are changing, but the numbers are no longer changing now. We're referencing the same row, only the top row. Okay, so the last one, we're going to make it equal to this. If you push F4, you're going to be able to see that the anchor keeps changing. If you're on a Mac, it's Command T, and we'll do a full anchor with both $ in front of the column and the row number. Okay, so hit enter, Control C to copy, and then Control V to paste. Note now everything is equal to 4. Well, that's because we anchored everything. Every single thing is referencing this cell now. So play with yourself and really look at these numbers here and what moves and what doesn't move. As you get more and more comfortable with working with data, this is going to be very, very helpful to you. All right, now outside of anchoring cell references, another useful thing that we can do is naming cell references. So let's look at the example here with the same data set of orders and order values. Let's say we wanted to calculate a tax rate, a sales tax rate. Now, we could say order times a sales tax rate, let's say 9%, and just type in the 9% this way and calculate the tax and then copy it all. But we've learned from before that that's not a good way to do it, because what if we wanted to change to 9% tax rate? Now we got to change all of these cells and, read the formula and copy it, paste down again. Quite a bit of work to update. So what we want to do is we want to take the variable out. Let's call it 9% for the sales tax. And then let's now have it order value times the sales tax rate. Now, because we want to reference this cell for all of the calculations, we're going to anchor that both row and column to make sure it doesn't move in the formulas there. Okay, and then we're going to copy. You know what? We can just hit the bottom right corner and paste it all the way down. So if we look at a formula here, we see that it's referencing the correct order value and the tax rate. Okay, so now that we have that, let's look at what we can do to calculate the total sales tax from all of these orders. Right? We have a couple of different ways where we can do that. One is we can take the sum of all of the calculated sales tax and calculate that sum, or we can take the total sales value multiplied by the tax rate, cell reference there, and they will be equal to the same. This one just shows more decimal places. Okay, but a name reference is different. Name references mean we take a cell and look at this right here on the top left corner. You know how it says the row and column number right now with I2? Well, we can change this. We can call it tax rate. Now, when you do this, you have to connect, so you can't use space. You want to use it with an underscore, okay? Or you can just call it tax rate like that. But I like to use an underscore for readability. Okay, we're going to hit enter. And now when we hover over that cell, notice that the name is tax rate. And let's change this to total order value. Okay, total order value. I'm going to change this label as just to be consistent. So now when we look at the cell, it's going to say total order value here. So for the name references, if we want to calculate total sales tax, we can just say equal to total. Notice that that variable for the total order value now shows up. We can hit tab and it selects it. See the reference? Times tax rate. We're going to say tax. Notice that now it shows up as well as a name range. And I can select it or just tab that. It references the correct one. And if I hit enter, we're going to have the same value here. Okay, I'm going to just convert them all, select them, Control 1, and make sure they're in the same format with no decimal places. Okay, so this total tax rate, see, this formula, by naming it, isn't it much more intuitive? We don't even need to look at what the cells are referencing and what label. It just says total order value times tax rate. Now we know that will equal to the total sales tax. Okay, continuing where we left off, we have these fixed and cleaned up data points for all four of our target symbols, our S&P 500 and our 3 cryptocurrencies. Now let's take this data and just run some analysis separately. Okay, so here we're looking at just the S&P 500. Okay, so these are all the data for S&P 500 going through to January, the first available date there, and all the way to October 20th, 2017. So here's 7 years worth of data, right? So something that's going to be helpful as we make the comparisons is to look at what the prices are at certain dates from the most current data point. So a year prior, 2 years prior, 3 years prior. For most of our data here, the Bitcoins and the cryptocurrencies haven't been around that long, so we probably don't need more than 5 years. So what we'll do here, if here's a date, what we can do to find something that is a year before, use a formula called eDate, select the starting date, which was the October 20th, 2017, and if I want to subtract the year, then I'll go minus 12 months, okay? Then what do I have? I'll have the 20th of 2006, 2007. And if I go all the way here, we'll see that I have all of those years. Okay. And then what I did here is simply to look up the value from the date and to pull the S&P 500 value. Okay. So it's at a little over 2,500, just under 2,600 as of October 20th right here. But notice that I have errors in these two, right? So those are dates where, for whatever reason, there's no data points. It was probably weekend. So what we can do is we can just offset it. Maybe let's just add one. 1 day away from it is not that big of a deal. Maybe we'll have 1 day off from one of those. So we'll do 21st and 19th for those. And now we have those values, right? We can kind of see how far it's grown over the years. Now remember how we did CAGR, right? CAGR is the compound annual growth rate, right? So if we look at all of this, we can calculate the growth rate for all the years, right? 1 year, what we would do is we take the current value divided by the value from a year ago raised to the power of 1 divided by the number of years it's been, and then we subtract it by 1 to get the percentage. Okay, so that if you don't remember this, go back to the CAGR lecture and you'll know what to do here. Okay, so we anchor the baseline here, 2017, because everything is to that, but I don't anchor the row for this reference because I want to calculate the other CAGRs as well. Okay, and then here, this is not anchored because we're going to move up in the year here for the calculation. Now, with that, see, I can copy this formula and it will calculate the CAGR for all of the years 1 through 5. So this means if you had invested in the S&P 500 as of October 20th, 2017, your 1 year return would have been 20%. Your 2 year would have been 12. 3 is 10. So over the course of the 5 years, it would have been about 12%. By any means, in terms of investing, those very solid returns. These have been pretty good years in the stock market, right? If you can average anything close to even 10% consistently, you will have a lot of folks that want to give you money to invest for them, and you will end up becoming very rich. So these are the CAGR rates, right? Okay, so we've calculated the CAGR. Let's take a look at a visualization. So when you have something where you have dates and values, and especially if you have a lot of data points, it's very useful to actually create a line chart. So what I'm going to do is I'm going to go all the way to the bottom. I'm going to select all of these data points. Okay, so the entire section. And then what we're going to do is we're going to insert a chart. All right, so see how there's charts here. We're going to go to line charts. And here so from here, what we can see is based on our data from the beginning of 2010 to October 2017, we see that it's been a pretty steady climb, and that is consistent with the CAGRs that we calculated, right? So this line chart is a really quick way to visualize this data. You have a time series data and data points. Now you can also put a trend line here to see basically how it has trended from the beginning to the end of that line. You can see it's trending from, you can see that, it took about 5 years to double the, approximately 5 years to double the return here for the S&P 500. And you can get an idea of where this looks. Okay, so now that we have this, what we're going to do now is take a look at the Bitcoin data. Okay, so I'm going to go to the Bitcoin tab. Now here, I've done the same thing already where we've calculated the CAGR and the same value. But notice here, look at the CAGR here for Bitcoin. The 1 year CAGR is 846%. All right, so if we wanted to compare the returns of, say BTC to SP500, right, I'm just going to take the CAGR, corresponding CAGR, and divide by the S&P 500 CAGR. All right, now we can see how many times the return is between Bitcoin versus S&P 500. Okay, so if I copy that over, we look at this 5-year CAGR, Bitcoin gave 20 times the return compared to S&P 500. And if we just look at this past year, as is represented in this chart here, right? Just look at this right here. We see that the CAGR in the most recent year is really high, so it actually returns 68, almost 70 times more than the S&P 500. Okay. So, but notice that between the S&P 500 and the Bitcoin, this doesn't have a good trend. So if we add a straight trend line, it kind of looks like this, and it's not very predictive compared to the S&P 500, where, you know, it's been quite predictive here. See that? So for the Bitcoin, so we see that the linear is not very predictive, right? It's not a good fit. It's really probably more exponential, if anything. Even then, it's not that predictive. And what that tells us is that there was quite a bit of volatility, right? It moved up quite a bit in 2013 and it crashed. It dropped from close to, I think it was 11, maybe it was a little bit higher, 1,300 somewhere. And then it crashed to $200 something and stayed there for a while, for a good 2 years before it kind of ramp up. And then really in this past year, it just started to become exponential. So just comparing these two, you can see already what that difference is, right? So what can we do when we put them together? Okay, so here in the next sheet, we have the S&P 500 underscore BTC. What we're looking at here is we have the data for the S&P 500 and the Bitcoin corresponding by date, right? And now, if we just carted them next to each other, we're going to see something like this, okay? So this is the same two charts we saw earlier, but now it's together. All right, so the way we're going to do that is select all that data, okay, and then add the line chart there. So review the line chart section or the charting if you're not familiar with this, okay? But I just wanted to show you what it would look like. Now, this is not quite as helpful though, right? Because, well, yeah, of course, you know, this has gone up a lot, but, you know, we want to kind of compare them on a even more apples to apples basis. This is just straight up pricing, right? Where the price is at. And we know that Bitcoin gave you better returns, but it's not as similar. So one way we can look at it in terms of investing in option A or option B is we can go to some beginning date, right? So here we started in May of 2012 because, well, we don't have any data earlier than that for the Bitcoin, at least from what we downloaded. Okay, so that's why we kind of stopped it there. Now, to show the headlines a little bit there, the header, we're gonna freeze it so we can see. So let's take a mental exercise. Let's assume, what if we invested $1 at the very beginning here in either S&P 500 or the Bitcoin, right? $1. So the way we're going to do that is see what that $1 becomes over time, you know, to all the way to the very top, right? So here we see that S&P 500 in the course of about 5 years, from, you know, May 2012 to October 2017, that $1 became about $2. Doubled your money. But for the Bitcoin, that $1 became almost $1,200, right? So how do we look at that? Well, the way we do that is we take the price at that time and divided by the price. Okay, so then we get a 1. But we anchor that price on the first day that we're evaluating. Okay, so then what ends up happening is, let's say look at 1 here. So we take this price now divided by the same starting date. So then everything is coming to the starting value. Okay, and that's what we're doing with the Bitcoin. Well, the first day was about $5, so 5 divided by 5 is 1, right? But then when we get to here, now we have 7 divided by 5. Okay, so we get up 1.3 here. Okay, so that's what we're tracking now. And if we chart these two, so the way we create a new chart for that is we would select those, okay, and then we will also select the dates. Okay, so we selected these 3, and then we insert line chart. Now what we have is we have both of them, the Bitcoin and S&P 500, but both starting at $1. And where would it be? Now this really tells you the extreme difference in returns between the two options, right? If you invested $1 in S&P 500, like, it pretty much stayed flat over the last 5 years. But if you invested a dollar in Bitcoin in 2012, this is what it's worth now, $1,200. Okay. Now, in the next lecture, we're going to compare Ethereum and Litecoin with Bitcoin a little bit, see how collectively those 3 big cryptocurrencies have compared with S&P. Hey, welcome back. In this lecture, we're going to do the bullet chart. Now, it's going to be a little difficult to explain the bullet chart without showing you what it looks like, so I'm going to show you the result first. Okay, so imagine we had data for the store where they are satisfaction scores at the store, customer satisfaction scores. Okay, they have target scores that they were going after, and then they had the actual values, their actual score. And then also the company had aside these definitions of scores and what tier they're in. So based on, if they're in the bottom tier, mid tier, or high tier. Okay, so the way the data is structured in this way is it allows us to visualize it so we can look at each store's score versus their targets. So these are their actual values, the bars. Okay, and then these are their targets, and we can see if they met their target or not, or exceeded or not, right? In this case, it didn't meet the target. This one exceeded target, and exceeded target here. Okay, so we can very clearly see, and we can see that all 4 of these stores, their scores, put them in the top tier if there were only 3 tiers here. Okay, so that's what a bullet chart allows you to do. It allows you to tell a lot of information in one single chart. Okay, so we're going to do that with this data. All right, so what we're starting with is just the data here. And what we want to start with is, since the data is all going to be right next to each other, you want to just figure it out for 1 first. If you figure it out for 1, you can easily extend and cover the rest of it. Okay, so what we'll start off with is we're going to take all that data, we're going to go insert column chart, and we're going to do a 100% stacked column. Now it's going to look like this at first, and it's not going to look anything like what we want. Okay, so we're going to have to do quite a few steps to turn it into what we want. And the first step is to right-click, select data, and hit the switch row and column. Okay, when you hit enter, you're going to see something like this now. Now what we want is we want the tiers to show up in the back at that up to 100%, because those are all 33.33%. And then we want the value in the target to show up in front of them, right? Now remember, we go back here. We want those to show up in front of those tiers. So that means they're going to be on different axes, all right? So what we got to do is we got to first put the target on. So what do we do here? We have the target on the line bars. Okay, so that's what we're going to do first. We're going to put the targets into these line bars here. So first we got to find the target value. Target right there. Okay, so now we're going to put that into line value. So what we're going to do is we're going to right click and we're going to go format data series. And we're going to put that on a secondary axis. Now it's going to cover everything, but don't worry about it. Okay. We're also going to change the chart type by right clicking on it. And then we're going to go to the line, stack line with markers. Okay. So now we have a marker, but let's make it a little bit nicer. Okay, so we're going to select that, go to this paint bucket here, select the marker tab, okay, and then you're going to see this drop down for marker options. Go to built-in, and then we're going to select the line one. This will make it show a little bit better. We're going to increase the size of it to 15 so we can see it better. We're going to fill it up with red, and that should be pretty clear now, right? So yeah, that's good. Okay, so now we have the target done. Let's look at the value one now, right? Remember, the value one we wanted to show up in front. So this one also needs to be on a secondary axis, right? Now, when we do that, it covers everything, okay? So we got to go to this Format Data Series tab here. So if you don't see it, what you do is just go right-click, Format Data Series, and then this will show up. Click on the one with the 3 bars. We're on the secondary axis. Now shrink the gap width so that we can see that versus the ones in the back. Okay, but we're not done. Right now, it's stacked at 100%. We wanted to show against the 100, right? So we don't want it all the way at the top. 85% should stop at 85%. So we got to select that column. Make sure it's on the right column. Yep. Right click. Okay, we're going to format it. Actually, we're going to change the chart type from the 100% stacked to just the stack column. Whoop, I didn't choose it. So we'll do that. Stack column. Okay. Okay. Yep. So now it is correct, but it's not showing up the way we want because this here is not formatted correctly. The right axis. Okay. So we're going to have to adjust the axes here. All right. And for the right axis, we want it to show up exactly the same as the left axis from 0 to 1. Okay. And we want the numbers to be percent. Okay. So now we have the value and we have the target. We can see where it is. And we also have these tiers in the back. For visualization, it's usually better to try to keep it in the same shade. So one of the things that you can do is use a dark shade. For example, if we want to just in black and white, and these will print out better, we can use the darkest for the actual data value, right? And make the marker here a little bit lighter if we need to. But then for the ones in the back, we can just use lighter shades of those things so that there's enough contrast. Just choose different shades. Oops, that one. For this one. So now we can see where it is versus the tiers. Okay. Now that we have this, when we select this chart, if you select the entire chart, you'll see that it shows just the store A here. We can now extend it across the store B, C, and D. Now when you do that, we have all of these data points. Okay, and the lines show up, the markers show up, and we also have the bars here. Now, if you think that this is too close, you can just adjust the colors more, make it, maybe show that one and just move all the other shades a little bit higher up to make it show more contrast, right? Like that. So now this black really contrasts from all of the ones in the background. It's very clearly easy to see. Okay. So it takes a little practice. Go through this lecture again and follow the steps that I did so that you can do this on your own and, practice it a few times until you're able to get this result and maybe change some of the data, create 4 tiers instead of 3 tiers and see how that works for you. Okay, so I just did a few more things to the chart. I want to show you when you have 2 axes that are exactly the same, we can delete one of the axes and, just from showing because they're all mapped to the same thing, so to avoid confusion, right? And then we want to add the actual values for the values of the scores, okay? And these are the targets here, and that's the target line. So there you go. You got this nice bullet chart that can tell you. Hey, welcome back. In this lecture, we're going to look at something different. We're going to look at a function in Excel, or a set of functions in Excel that is very frequently used in finance. And these are the IRR functions. Now there's 3 IRR functions in Excel. I'm going to explain to you the differences between them. IRR stands for internal rate of return. And the best way to think about what an internal rate of return is, if you have an investment that requires some initial cash investment, and then you're going to get some returns back over a period of time. If you were to look at it on an annualized basis, what would that return rate be? And that's your internal rate of return. So however the cash flows are laid out for the different investment options, if it were laid out as though you're getting a consistent annual return, what would that return equivalent be? That's your internal rate of return. Okay, so let's see an example here. Let's look at the first 8 investments here. Well, all 10 investments actually. They all require an investment of, say, $2,000. All right. Now, investment 1, you get these cash flows over the course of 5 years. So the total cash flow during those 5 years is equal to 4,000. So investment 1 through 8 have the exact same cash flow over the first 5 years, except the amounts and the timing within those 5 years are different, as you see here. So the IRR is simply IRR, and we select the values from the time of investment to the last year of the cash flows. And then we, okay. Now we can copy and paste this formula, Control Option V, formula, okay, and calculate that down. So we see that even though the cash flow over the 5 years, the total cash flow is identical, and even though the initial investment is identical for both of these, the IRR is quite different. We see that as cash flow return gets progressively earlier in terms of when you get that investment back, your IRR is higher. So what that means is the earlier your returns, the faster you get your investment cash flow or profits, the better investment. Now we can copy the formula as well for these investments here. These are a little bit different. I'm going to talk about it a little bit later, but let's just put the formulas here as well. And we're going to paste that there. And notice that the IRR are identical for these investments. Okay, so one of the big issues that folks have with IRR is that the IRR itself assumes that any of the cash flows that is received during the period of the investment is reinvested at the rate of the return. For most people, that's not going to be true, right? You have the investment returns and you put it in a bank, or they may invest it in something else. And that's why many folks, instead of using the IRR, they use what's called a modified IRR function that accounts for this shortcoming of the IRR itself. It doesn't assume all the returns are reinvested at the same return rate. So to use the IRR, or the modify M IRR, we use M Irr. Again, we take the period from the investment to the last year of cash flow. Then we enter what's called a finance rate. That is, if you borrowed the money for the investment, what was your rate of the financing, the cost of financing? So you can think of it as an interest rate. If you had to borrow money, what would that be? Let's say you borrowed it at 4%. And then the amount that you get back during the investment, what do you think your reinvestment rate could be? Now, if you put in a bank, that's probably somewhere between 1 or 2%. Maybe some folks want to put it in a mix of low-risk treasury bonds and municipal bonds, and maybe they're able to get, aggressively percent return. Okay, we're going to assume that for our example. Now we see that the modified M Irr compared to the IRR is a little bit lower, right? So if we select these and copy the formula, just the formula, we see that the M Irr for these investments aren't that much different. Yes, this last one is still better than the first investment because you're getting it way earlier, but it's not 100% versus 17% better. It's 19 versus 15% better. So there is a pretty significant difference here, and that is the reason why some folks prefer to use M Irr for their investment calculations. Okay, let's now look at X Irr. See, another problem with the IRR is that it assumes all of the payments come at the end of the year. So if I put some dates here for when the investments go out and when the payments come in, let's see what happens if we factor the dates in rather than just assuming everything's happening at the end of the year. So there's a function called X Irr that will take the values, but it will also take the dates, now anchor the dates, close that. See, now values are higher than the original IRR, and if we copy and Control Option V, paste the formulas, we see that the X Irr is very different. And because of the dates here, because this is happening towards the end of the year, this is happening very early, the X Irr is extremely high for this last case here, okay? The gap between the two dates is much smaller. These assume a year almost of difference, right? These do a year versus this one is factoring the dates here. So there's quite a bit of difference between these. The disadvantages of the IRR partially addressed with the modify IRR. However, the modify IRR also falls prey to not being able to factor in the dates. So in terms of preference, many folks will use either X Irr or modify IRR depending on the project to calculate the IRR. But if we look at the example for investment number 9 and 10, it will show that you cannot use any of these formulas for IRR by itself. Here's why. Let's look at these two investments. They're both $5,000 investments, but one of them you get a $25,000 windfall in the last year, and the other one you get a very good return through the 5 years. If we just look at the IRR, they're identical investments. If we look at the modify IRR, then the investment 9 is better. It has a higher modify IRR than the investment 10. However, if we look at the X Irr factors in the dates, we see that the X IRR says the investment 10 is better than investment 9. So what should we do here? If we use IRR, it says they're the same. If we use M Irr, it says investment 9 is better. If we use X IRR, it says investment 10 is better. So it's very confusing to look at it in this way, right? So in order to evaluate this better, we need different measures. And we're going